Chevron Corp, ticker symbol CVX, is currently trading at $149 a share. They have recently reported their fourth quarter earnings for 2024, and we're going to be going through those numbers. Then we're going to be looking at my automated stock valuation spreadsheet, looking at Chevron's latest financials and seeing if it's a buy or sell using the discounted free cash flow model, the comparable company model, dividend discount model, and Ben Graham formula for intrinsic value. So, just quickly touching upon the stock, year to date, the stock is up 3%. Over the last year, it's actually down 2%. And even over the last 5 years, it's up 37%. But from the bottoms of the 2020 pandemic, is actually up 150%. Also pays a very nice 4.58% dividend yield. We'll talk about more in a minute. So just before we get into this, we'll look at my automated stock valuation spreadsheet and we'll put in the ticker CVX, and this will load up all the latest company financial data, and then we can have a little breakdown with the latest earnings. So $268 billion market cap, P ratio of 15.36, which is much lower than the market average, which is currently at 30.2. Earnings per share $9.72, and a beta of 1.12, meaning it is slightly more volatile than the market. Analysts do have it at a buy, $176.97 a share, so that is a buy, and quite a substantial buy according to analysts. Dividend, we've said before, 4.2%, meaning you'll get paid $6.23 per share. It is a safe dividend, about 67% of the net income and 60% of the free cash flow, and that is $11.2 billion they pay out each year. Now, if you want to get paid the dividend, buy before the 18th of February, and you will get your quarterly dividend. So let's have a look at the revenue numbers here. 197.57 billion in the trailing 12 months, so actually a slight decrease from the prior years. If we do look at the net income, 16.68 billion, and actually this is where we can see a little bit more information about this. If I just scroll down a little bit here, we have the segment highlights here, which is the upstream, which is the oil and gas production, includes identifying, extracting or producing materials, and then we have the downstream, which is the post-production of the oil and the gas activities. So we have here the US upstream, this is the earnings, and this is the third quarter of 24 versus fourth quarter of 24, and also we have 23, and then the full years here as well. Just quickly, this is million, which is billion, MBOED, which is the thousands of oils equivalent per day, which measures oil and gas production, combining oils and barrels and gas, and it's obviously per day. Then we've got MBD, which is the thousands of barrels per day, MMCFD, which is the million cubic feet a day, dollars per BBL, which is dollars per barrel, and then finally for the gas, dollars per 1,000 cubic feet. So I'll be touching on these again, but we can see that the fourth quarter is up from the prior year, minus 1.3 billion up to 1.4, down though in the prior quarter. But if we have the full year, you can see 4.1 to 7.6. That is the key thing for US upstream. We have international upstream. I won't talk about the production and the realization, but we'll just look at the numbers here. Earnings 2.9 in the prior year to 2.8, and it beats the prior quarter, and actually down 13.2 to 11 billion. So it is actually their largest segment here. We've got US downstream. We'll do 23 versus 24. 3.9 billion down to 500 million. And then finally 2.3 to 1.2. So that is in terms of the earnings. Free cash flow down slightly, 18.76 billion, but still massive cash flow generation, but down from its all-time highs, and sort of been relatively steady over the last few years. If we look at operating cash flow versus CapEx, we can see CapEx has increased, operating cash flow has remained relatively flat, which is why the free cash flow is down slightly. Shares outstanding. They have recently bought back shares, and they are continuing to buy back shares. Let me just see if I can see it here on here. Yes, returned a record 27 billion in cash to shareholders in 2024. So they are rewarding shareholders through buybacks. So let's have a look at the discounted free cash flow model. This way of valuing stocks, looking at their future free cash flows, discounting them to today's value. So currently, let's just see, we have currently got a share price of $176 a share. Let's see if we agree with that. So look at the revenue growth. Ooh, see, this is a good high. 10% growth, 100, 218 and 240 billion in the coming years. Let's see what analysts say. 200 and 207, interestingly enough. So we'll bring that down quite a bit, and we'll say we'll go 2.5% growth. Oh, actually, what I should have looked at as well, just while I'm there, we can see the growth rate expected over the next year. And analysts say, oh, quite high, 18%. So that's quite interesting. Okay, so we'll put it a bit lower. So that brings it down to $132 a share. Net income margins, I'm pretty happy with that number. In fact, I think that number was sort of an aberration there. It was a certain year. We all know what happened that year, but you can't say it because YouTube will ban you, even though we all lived through it. But anyway, so that's 10%, puts us back to 177. And the net income to free cash flow, I would say we need to increase this. 111% will go 110, and massively undervalued according to the discounted free cash flow model, which is quite interesting. $235 a share. Now, obviously, this is quite high on the free cash flow net income. Let's bring it down to even 95. Still $200 a share, so a massive buy there. Dividend discount model. Let's have a quick look at this. We'll add up the weighted average cost of capital, and if they are growing, yep, at about 5% a year, which is very achievable for them, that will put them at $166 a share. So dividend discount model does also say it's buy. We'll quickly go through the Ben Graham formula for intrinsic value. Oh, is this one where it likes it? It finally happened. See, people say, oh no, AAA bond yield has increased to 5.46%. So we'll change that. Oh, but still, let's see if we have a look at the expected growth rate. What did we say it was? It was about 15%. 18%, even higher. So expected to outgrow the S&P 500 next year, which is very interesting. So this is why this is a good stock potentially. We'll do 18%. So Ben Graham has it to buy $207 a share and a Graham price of $155. So to the commenter who said, does Ben Graham formula ever like the stock? And I said, not at the moment. Well, this is the first one in a while where he has said it's a buy. So very interesting there. So finally, we'll have a look at the comparable company model. It's the way of valuing stocks, looking at their competitors of similar size and industries. And we'll look at revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book PEG. But then specifically the metrics are EV to revenue, EV to EBITDA, PE, and forward PE as well. So ticker XOM, I think that's a fair one. It's the largest US oil major. Exxon, and it'll load all the company's financial data. So if you're interested, check my Patreon, links in the description, but we won't talk more about that for now. ConocoPhillips, this is an independent oil and gas producer, COP, and Occidental, which is, I believe, Warren Buffett. Does he still invest or used to invest? Let me just have a quick Google on my other screen. Oxy Buffett. Yes, he is still purchasing Occidental, so that is interesting, people. So let's just have a look here. Enterprise value, Exxon is the biggest revenue. Revenue growth rates, not as high as the other two, which are a lot smaller, but higher than Exxon, which is good. EBITDA second highest, net income second highest, profit margin smallest, price to sales, market averages around about 3. These are all below that, but Exxon is towards the lowest. Price to book, market average is 5, once again, towards the lowest. PEG, we want to be, this is Peter Lynch's price to earnings growth. Ideally you want this under 1, but you can see none of these are close to 1, but it's sort of middle of the pack once again. EV to revenue, second lowest. EV to EBITDA, towards the average. PE, one of the higher ones, and forward P. So yeah, ignore those colors there, but you can see because of the EV to revenue, it is a buy at 149. But if we would compare against, say, Shell, take a simple Shell and BP, let's see what this will give us here. Now these are a lot more similar size, 250 billion, 116. Interestingly, not a buy, $124 a share. EV to revenue, one of the highest. EV to EBITDA, second highest. BP with a much higher PE ratio, as you can see there, 31. Sort of an outlier there. And forward PE, one of the low ones. So the comparable company model says it's about fairly valued, or maybe a slight overvaluation. Dividend discount model likes it. Ben Graham formula really likes it, and so is the discounted free cash flow model. Interestingly, Ben Graham formula and discounted free cash flow model are about the same price. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. Check my Patreon. I haven't got the page open, but I can't bother to open it. But yeah, we're a growing community there. People are happy with the product, happy with the sheet, and you have full access to all the data, and you can do as many stock reviews as you want. Right, catch you next time.